Today, I'm going to be sharing with you the best tax efficient withdrawal strategies for retirees. So, the first strategy that exists when we meet with a client is using what we call the standard deduction secret weapon. And what that standard deduction secret weapon is we want to strategically allocate a certain amount of IRA dollars when we reach age 73, which is the age that the government is going to force us to pull what's called a required minimum distribution so they can tax you on your IRA dollars, that proportionally comes out to the standard deduction, which is the automatic amount of money that you get to deduct off of your tax return. So $29,200 if you're married filing jointly, or $14,600 if you're filing single. And so we want the government's going to make you pull about 4% of your total account balance. And so we want to back in and say, okay, what's the strategic amount that we keep in an IRA that we got a deduction when we paid tax, when we contributed to it, we got a deduction on those dollars, the money growed tax deferred, and then we go to take it, we actually don't end up paying taxes because our standard deduction eats away at what we call the provisional income of that IRA. So we pay a 0% tax on that IRA distribution because of the standard deduction. The next thing is utilizing what we call Roth distributions. So if you're a pre-retiree or if you're a retiree and you did this, you can set money aside in a Roth IRA or a Roth 401k. You pay the taxes on the dollar today, the money grows tax deferred, and then when you get to retirement, you can strategically take the dollars out tax free. And one thing that we find that clients miss, is at age 59 and a half, we can start shifting dollars from the pre-tax to an IRA or a 401k into the Roth bucket, withhold the taxes, and do that between the age 59 and a half and 73 before the required minimum distributions kick in. And how we want to strategically do this, and we call it the retirement tax planning roadmap, is we want to take strategically the right amount of money out that we either don't go up a tax bracket, we don't raise our taxes at all. How do we strategically take just the perfect amount of money between 59 and a half and 73 to gradually shift money from a taxable environment to a tax-free environment? And a lot of people get hung up on the fact that they're still paying taxes. But the idea is that you're paying taxes either at a lower tax rate before taxes go up or potentially double by 2030. That's a whole other conversation. Or you just give yourself the optionality to pay at today's tax rate and not be forced to pay taxes at age 73 on the requirement distribution. Because when that RMD hits, that counts towards your provisional income, which could potentially increase the taxes or cause taxation on your Social Security benefits. So this is a way that we can control the destiny on the taxes of your Social Security and hopefully minimizing them. Another strategy that exists is what's called tax loss harvesting. So sometimes when we have a client or a prospect, they'll have money in an investment account that triggers a capital gain when they sell shares. And so one thing that we can do to reduce capital gain taxes is if we sell something at a gain, well, then we go find an investment that is down and it's a loss of equity. And that can be used as a deduction to negate the capital gains taxes. Now, capital gains taxes can be fine. They're less than ordinary income, which helps. But once again, we're trying to get that provisional income down. And so tax loss harvesting is a way that we can take something that went up, something that went down, and we can negate it and bring it back to floor level to reduce taxes in the present. Another strategy exists is what we call the rich man's Roth, i.e. life insurance. A lot of people, when they think of life insurance, they think about the benefits that come with passing away. What they also don't realize, even when they think that way, is that life insurance is a tax-free vehicle. So if you were to pass away tomorrow and you have life insurance, that life insurance death benefit pays out 9 times out of 10 tax-free. And so that's a really unique advantage in the tax code. Well, a lot of people don't realize that it can be strategically designed as a savings vehicle. And so where the money actually accumulates and grows tax-free, and if it's done properly, can be distributed tax-free in retirement. The reason it gets the name the rich man's Roth is, one, some people, when they'll sit down, they'll say, hey, I make way too much money to do a Roth IRA. Or I have a Roth 401k, but I cap it out pretty quick because I make such a good income. Well, this is a way that if somebody makes a high income, they can use this as a rich man's Roth to put money into. And where the rich man's Roth really came from is the Rockefeller family's most notable family, that they would take out life insurance policies every single time somebody was born. They would strategically design them where they accumulated it with the cash value that could be used for retirement, buy businesses, expand the business. And then when every time somebody died in the family, it just prolonged the generational wealth because that tax-free benefit kept coming in at the time of somebody's death in the family. And the last strategy that can exist is what we call a qualified longevity annuity contract, or in short, a QLAC. And what this allows us to do is take a percentage of IRA dollars and put it in an annuity that you don't have to take money out until the age of 85. And why this is really unique and cool is what a lot of people don't think about is by age 85, you're older, maybe you don't feel as well, you're not as active, you're not spending as much money in retirement, which means your income is going down, which means your income taxes are going down. And so you can take up to 25% of your IRA balance, put it into this QLAC. The money grows tax deferred. You're deferring those taxes on the income. And by the time you start taking it at age 85, your spending has most likely gone down. So that reduces the tax on that percentage of your IRA that you weren't needing to spend, and it got it off the grid of taxation for a period of time. So these are just a few of the strategies that we incorporate with clients and retirees to help them reduce their taxes in retirement.